It's just the idea that we're trying to get this right, and this is if you think of the two things as separate variables, then I think that the skip, I shouldn't call it a skip, the decision makes sense.
Well, he let the skip slip. Hope you're all doing well. I'm back from vacation, and yes, the Cocoa Bear remained in hibernation, as you can see. Well, the Fed came out today, and kaboom! We saw a big move in the 2-year yield, bringing us down to a bone-chilling 91 basis points inverted on the 10 and 2, making us wonder, are they going to remain to hold these interest rates where they are? Is this a pause? Which he didn't use the word pause, he used the word skip, while the market is now pricing in a potential rate increase on the next meeting. You can see the probabilities are increasing there. So we will see if that is actually the case. We did get CPI data while I was out, and it is decelerating. Core inflation still remains really high, as it's been in the 80s, with a target of 2%. Now, if you broke into these reports, you'll notice a couple of things. The things that are still really high from a year-over-year perspective are the things that really matter to us humans, us individuals. For example, food at home was a 5.8. Food away from home was 8.3% year-over-year. You got shelter, rent of primary residence, owner's equivalent rent too. They're all 8% plus year over year. And then you look at maintenance for vehicles and even motor insurance. The things that came down was really energy and commodities. And then airline fare, which airline fare, I don't know. I'd have to look into this, but I'm pretty positive that it's not including any fee structures that were added on. But don't quote me on that. Now, to note though, one of the hedge eye analysts did mention that food at home, albeit that it is high, it increased 5.8% year over year, it did decelerate. So the rate at which it's coming down is at least, positive, where it could very well decelerate at a faster clip and be obviously better for us consumers. What else taking place? Speaking of consumers, well, if you look at the United States Red Book Index, this looks bare. It does not look good at all, which tells us what? Sales from retail doors are not doing good. And this is on the back of credit cards that are on the rise. These are balances, credit card balances, okay? So this continues to increase while delinquencies are starting to pick up there too as well, which we've shared in prior episodes. And on top of that, the interest rates are the highest that we've seen. Well, this chart dates back to 1995. And let's go ahead and just tie it all together on a little bow. The savings rate is also just floating around an all-time low dating back to the 1960s. So the consumer seems pinched, but you're not really getting that in the financial markets. Because if you look at how they're doing year to date, well, the SPY's up 14%, the Qs are up a whopping 37%, IWM is up 6.6%, and the Dow Jones Industrial Average is up 2.74%. I'm using the DIA, IWM Qs, and SPY there, okay? That's the year-to-date performance. So is it going to matter? I can't tell you if it's going to matter or not, but what I can tell you is the data does not look all too hot for the everyday consumer. So if it matters, well, it shouldn't look obvious if something bad were to take place as far as a recession goes. It'll be all very obvious in hindsight. Now, if we take a look at the 11 sectors that make up the S&P 500 today, well, what took place? Oh, and by the way, as far as the change today, IWM was down for the day. DIA, the Dow Jones, the diamonds, right, down 0.6, and then relatively flat for the SPY after today's announcement or Fed decision, and the Qs were up there slightly as well, almost 1%. Why? Well, it led by tech. Tech was up 1.3%. Consumer staples, a defensive sector, was also in the lead there, while we had energy and healthcare towards the bottom of the list. Why did technology go up 1% today? Well, the biggest leader within that sector was semiconductors. Those were up 2.62%. And it makes sense because from a year-to-date perspective, if you look at all the large cap names, I mean, you're seeing massive gains in all of them, except for one. Wolfspeed is actually down on the year. NVIDIA is the biggest one up here at 194% year-to-date. Holy moly. Now, before we get into like the technical aspect of things of when to get potentially bearish, when to get bullish, and some of the indicators that we look at. I want to just read off this tweet so you get a good idea as to if the market starts changing, how you can adjust as well. So one of the basic principles of technical analysis is that markets move between contraction and expansion. If you are in the swing trading group and you see the trade ideas I post, the majority of them are all price action that's getting very tight, right? Contraction. And then you want to play breakouts or breakdowns where it has well-defined risk on either side. Why? Because markets move between contraction and then expansion. And the goal is to get the expansionary volatility when it increases on your side. Now, as of recently, breakout trading has been working very well. Now, a basic principle of trading is making money goes from easy to hard and back again. And I want to just reiterate this. It has been very easy, relatively easy, to make money as a breakout trader in recent weeks because price action has really been just going one way. And I want to tell you this now because you need to get good at adjusting when the market adjusts. You don't want to get caught if things start going down. You're like, no, just buy the dip. I'll buy the dip. I'll buy the dip. And then all of a sudden you're like, I'm just going to get out. And then the market rips up higher. Okay, this is typical what happens to people that aren't very, they're not managing risk very closely. Okay? All right. And by the way, this is only $9 a month or $90 for the year. You get a 16% discount if you want to join this. This is not an alert service, but I give a lot of information out for that price. I'm not going to talk much more about that. Let's get into the S&P 500. We're going to start off looking at the book map because there are some key levels on here. If you don't know what book map is, this is like, have you ever heard of level 2s? Like level 2 data is that stuff that flickers back on the screen. It's very hard to read. Well, this lays a heat map on your screen so you can visualize key levels if you're trading intraday. I love to use this for intraday trading. It allows me to see where orders are and I can build trades around there based off of good probabilities, risk, and reward. Okay, and it also helps for swing trading as well to an extent because you can get potentially see some bigger levels over time. Okay, and by the way, Bookmap offers my subscribers a discount. If you want to see that, the link is in the description below. I think it's up to 40 to 50% on some of their bigger products there. So let's go on. There's a couple markings on the screen. The top one here is the daily expected move, upper, and then the bottom one is the lower expected move. Now I'm showing you on Bookmap and not a candlestick chart because there are actually some levels of interest here as well on the Bookmap. So we're looking at ES, right? This is the new contract. We just had a contract roll. It's sitting right here at 44.40. There's over 500 contracts, and the longer that this stays here lets me know that chances are it can act like a magnet and good price would want eventually to absorb that. Now it can get removed in a heartbeat. Very similar to how, well, we had some big orders down here earlier at 43.50. That was over, it was about around the same size, but they obviously got pulled. So we'll see here if those get added back come tomorrow. Okay, so just be aware that 44.40 could be a level of interest playing into tomorrow. It might be able to pop, and maybe if it pops through that, right, we might come up to the upper daily expected move, which is right around 44.50, and then, hey, you never know, it might pull back in. The lower daily expected move is right at around where this low was on this. We had this low on the kind of just this big drawdown intraday, and then we had this pullback, which was right around the Fed meeting coming, I think it was around the week to date anchored VWAP 2 as well, which we'll pull that up momentarily. And then we bounced from that level into the close. Okay, so those are some key levels. I want to show you a monthly chart and the expected moves that are here. So as far as the quarterly expected move goes, that's actually right at around that 44.50 level. Okay, so if price wants to come up here, you're also going up against the quarterly expected move. The quarter ends this month. We still have half of a month left. Just so you note, the price is actually outside of the monthly expected move right now. And if you're aware of these expected moves, 68% of the time, price closes within the expected moves. So as we're trading out, if we go up a little bit further, there's still a high probability chance that we pull right back into that zone. Now, if we look at the SPY on the daily time frame, still doing pretty well. We keep on trucking up, a new high today for the year. We're getting pretty extended from the quarter to date, year to date anchored VWAPs as we're kind of running into this prior area you can see of supply where we broke down. So it potentially can act as overhead resistance, but as it stands right now, when do you get bearish? Well, you get bearish, like we've said, if price gets underneath the 5-day moving average, that purple line, and then it starts neutralizing and then starts turning down, is when you'd say, okay, now I can give it some space, okay? Because as it stands, we said, as long as it's inclining, the bulls have the short-term control. Now, as it stands here, you can also see that we're right at the weekly upper expected move. So the weekly upper expected move, you can see we broke from that today. We saw some decent volume earlier on, and then it got sucked back in. And you can see we just danced around the week-to-date anchored VWAP. So if we start breaking down from the week-to-date anchored VWAP, start paying attention to the lower daily expected move and wherever the 5-day moving average comes from that level. Okay, that could act as a potential level of support where we bounce around. Now, understand, it's not like you just buy it on the bounce. You want to see how price works itself out in these areas. And then if it starts moving, builds a base, then it'd be a little bit more comfortable where you have defined risk, because if it comes right back, breaks out, and boom, comes right back down, well, then it can open the door to obviously the month-to-date anchored VWAP, to potentially the lower weekly expected move. We've seen crazy things happen. So that's kind of what I'm looking at, is if we start breaking obviously this high, then we have the door for 440.38 there on the SPY. So we just got to be aware that the day after the Fed meeting, we have, I believe actually tomorrow too. Let me just check really quick while I got you on the line here. Tomorrow is the retail sales month over month. That opens up actually an hour before the market opens. So we'll see how the market adjusts to that. But I can tell you this is the market trying to price it in. 440 to the high end, 433.98 to the low end. We'll see here if it finishes within that. Nasdaq 100, let's get into that. You can see we are right up against the monthly expected move, and we're well outside of the quarter to date. So we're above here, we're above there. Is price going to start taking a breather? Now, what's crazy is look how far disconnected we are from that monthly 5 EMA. This is the most frequently tagged. It's very rare that when we get way disconnected, you know, it's very likely to see some sort of snapback or reconnect, right? We disconnected, we connected. So we disconnected, we reconnected, and so forth. There's been times where we've disconnected multiple times, but it always finds its way to reconnect. So if we close up here, this will move up, and then always pay attention to a potential reconnect. And if it can hold above it, that means the trend is still your friend. Okay, if we take a look at the daily time frame, we did reach up to fill that gap. That was one that I was thinking that we could potentially go up and fill that, and we did. So where's the next area of resistance? Well, we're right at around these areas. So as price keeps on kind of trekking higher, we haven't really gone through any consolidation or anything like that. You can look at the RSI down here. The RSI is its highest. I should have pulled up the weekly time frame, but it's, we haven't seen it this high since really, I guess dating back over to here, right? It was right around these ranges where we saw this move up, and then it kind of just chopped around. Topping is a process, right? It's never too easy, and I'll show you some indicators here about the Qs of the Nasdaq, which are very interesting that we should be paying attention to. But should we be bearish? Should we be bullish? Well, we're still above a 5-day moving average. We're getting pretty disconnected from that 5-day moving average, and when we do, we kind of snap back. We got under it for a little while over here, and we said to be cautious on these moves back. Well, then we got right back above it, and it acted as support. It started to neutralize, right? But it didn't start to decline, and now it's starting to incline again. So all this was just a little head fake. Boom, boom. We started moving up. We're at and above the weekly expected move. Tomorrow's daily expected move is 370 up to the top, 361.79 to the bottom. Okay, so it's pretty disconnected. This is not the area where I would be looking to chase, and I'll show you why here on some indicators. Even despite going up further, there's still a good risk to reward here to pull back in, and you just got to be aware of that. Okay, let's take a look at some indicators. Now, this is one that I showed you from the Almanac Trader, and it was the pre-seasonality chart where all the dashed lines were pre-seasonality. Down here was the trading days in the month, right? 1, 2, 3, 4, 5, 6, and we're right here going into day 11. And I just wanted to share with you that, hey, seasonality is like, it can work sometimes, it might not work some other times, but it's still kind of nice to just get a good idea as, hey, can we potentially, and where would it potentially pivot? Because if we catch earlier on that, hey, it's tracking, well, where would the potential next pivot be? And so we're right around this area, and I'm just calling out that, hey, you know, in just a couple of days, right, it looks like it's flattening out over here, maybe a little bit higher, but then we actually start, you know, topping out around the 15th, 16th trading day, and we're right at around, obviously, the 11th, right? And if this is getting pulled forward at all, then you see subtle pullbacks, and then you could potentially see rallies thereafter. One other thing to call on the Nasdaq, more importantly, he posted this, where this is 2023 where we are, and it's obviously up 30% year to date, so a big move. And this is because, well, based off of pre-election seasonality, Nasdaq's best 8 months are into mid-July, and we're not too far off at this particular point in time. And if it's getting pulled forward at all, well, we are seeing that, you know, pretty strong rise. So even if we pull back a little bit, consolidate, right, tops take times, understand that into July, this is where things kind of level out and you see a little bit more volatility. So if that is the case and you're in a lot of tech stocks, you can start looking, you know, updating risk parameters, and that could be taking profits off the table, could be updating stops, it could be getting out of positions, however you best see fit in those times. Now, if I take a look at the Nasdaq Composite Bullish Percent Index, we are still overbought there. If we take a look at the BPNYA Bullish Percent Index for the NYSE, we are in overbought condition there. Energy, we're right there in that overbought condition too. The technology sector, the negative divergence, so as this is continuing to run up to a little bit extended areas, and we still have that negative divergence. It played out once, boom, to the downside. Now we're coming back up into overbought condition, and you can see that the negative divergence still remains there. Here's the percent of stocks above the 200-day and above the 50-day. You can see as the S&P 500 rises, these have been weakening, right? So you can see this high and a higher high, where this is a high and this is a lower high right there. This was also now is starting to be noticed by some more traders. Some bigger traders just actually announced this one on their Twitter pages today. But this is something that we have been tracking and watching because it works in bull cases and it works in bearish cases too as well if you pay attention for divergences. If we take a look at growth over value, the rate of change is right there remaining in the flat zone. So if it does start ticking down into under zero, this could potentially be a turning point or a period of consolidation, as I've marked out many times before, where the rate of change crosses down through zero between growth and value. As it stands right now, we did cross down underneath it, but it's just floating right there around zero. We haven't really got a thrust type of move to bring down into the negative territory for that rate of change. Saylor to Schiff tool, I shared this one before vacation, and the line was actually above the zero line, but we still had like a day or so to go in the weekend before the weekly candle changed. And well, we had a down day that was strong enough to actually close us just into negative territory, meaning that the signal never actually change, which means there is no bullish trigger that can come from that. So we need to wait once again for this to cross back above zero, right? And then get a trigger, which would mean that the price action has to get above the high of the prior week. So as it stands now, the current signal is still activated, and that is a sell signal. And we're seeing some weakness down into around the 25,000 area. If we hop into commodities, I'll show you that here. We saw some weakness, dropped right below that 25,000. If you look at Bitcoin relative to the S&P 500, it is below the 50-period EMA, and sometimes when we get above that level, it can act as, you know, some strength coming in because, well, showing us that, hey, relative to the S&P 500, Bitcoin is the place to be. Well, now, because this is starting to turn over, it's basically saying, hey, this could get volatile. If it starts heading down, the place to be is more the S&P 500 because it's winning out on a relative basis. Okay, that's why if this line goes down, that's what that means. Okay, so where can it potentially go to? Well, I was originally saying 25,000 on this breakdown. If it wants to go down further, start looking at the 200-day. The last time it was there was right over here, and we did find some support. Okay, so that's what we'll watch. If you take a look at oil, down 1.66% today, I still think that this is sniffing out recession unless something happens and something changes quick, right? This news over here on the it was a news event. I forget exactly which one it was, but it really brought the price of oil back up, and then that just got faded. We had another big news day right over here, which was like right over here into the 50-day, and that thing got faded. So we'll see here if we get a new news thing that comes out and we start moving back up again. But as it stands now, pretty gnarly topping looking pattern. And if we start to continue down, right, every big peak in oil has to a potential recession, and that goes back to like the oil embargo. Okay, so if we continue on, copper was also up today. That could be because, well, the dollar took a big hit to the downside, which will show that chart momentarily. But we still have that negative divergence forming as it stands right now between copper and the S&P 500. If we take a look at gold, gold is just kind of consolidating here. Surprisingly enough, though, for dollar being as down as it was, gold was up very itty bitty. So I'm still thinking here, if we start crossing down through 1925, just be more on guard. That would be, it opens the door obviously for lower, like 1850. But if it comes down and then comes right back up, it could create a U-turn type trade. So we'll watch that too. If you take a look at silver, which is the red and green line, I have the black line outlined, the black candlesticks, and that's actually just gold miners because there's a very tight correlation, as you can see. Well, that was up 1.19%. So if silver does start catching a bit and moving higher, I'd pay attention to miners because they can very well follow. Let's end it here with the dollar. So the dollar was down quite a bit on today's news. That helped up, obviously, the S&P 500. It helped out copper. It helped out gold. It helps out a lot of assets. And this is important to note, okay? Because, well, the correlations between the dollar and the S&P 500 are now back into negative territory. So the short term, which is 15 days, we have 30 days, that's still a positive. But there was one thing that we said over here, it's saying that there's one thing that I can, if I could bet on, I would. The correlation will eventually go back to negative. And now it's diving deep into negative territory, which means from a shorter time perspective, if the dollar starts moving back up again, that very well can hurt the S&P 500. If the dollar starts dropping further, that can actually level out the S&P 500 to make it go higher. That is a possibility from a 15-day correlation standpoint. Also to note, if we take a look at the weekly expected moves for the bullish dollar index fund, which is UUP, I wanted to just call out down here right at around 2810 is the lower weekly expected move, and we're not too far from that level. So if we come down into this range, it could very well potentially find some support as we've seen this take place with weekly expected moves. Okay, that could very well pause the kind of pullback in the dollar, and then we got to really kind of see if the 50-period moving average holds, and then we eventually start moving higher. Because if we do start to move higher, and this is just kind of cupping, and the dollar wants to head, significantly higher, that could be very bad for commodities. It could be very bad for various assets that are out there. Okay, that's all I got for you on today's episode, everybody. I'll see you later. Bye.